this video, I'm going to be covering in-depth summary of what I believe is the #1 book for traders. If you are a trader trading forex, stocks, cryptocurrencies, there is no more important book to read than this book by Mark Douglas called Trading in the Zone. This book was the single thing that took me from a trader that was why I'm so emotional about my trading, why I couldn't make money consistently in the markets, is I'm going to condense what would take you about 8 hours to read this book into like 15 minutes of the most important concepts in this book. So if you've never read this book and you're a trader, I don't know what you're doing, but watch this entire video. And if you're a trader that has not yet found their edge or is not yet consistently profitable, make sure you watch this entire video. Now, with that being said, when I cover the main points in this book, I'm going to be covering it with this little mind map where I'm going to tell you about the most important key concepts. I'll also make this available for free so you can download it in the description down below. Now, if it were to guess to me, this is probably the trading book that's made more millionaire traders than any other book on the planet. And the insight in it is absolutely timeless. So let's go ahead and let's actually talk about the main components. So we're going to talk about the 7 keys to consistency, the 5 fundamental truths, how to think in probabilities, the 3 most common trading problem, the 3 stages of development of a trader, how to trade your edge, and then what it takes to actually put on a trade. So let's go ahead and let's dive in right now. So the first topic that I want to cover are the 7 keys to consistency. So if you're a trader that's struggling with consistency and maybe you'll hit a winning trade and then you'll lose some and you can't really find a consistent edge, then pay attention. Okay, the first thing in creating consistency is you have to objectively define your edge. What does that mean? That means that you have to have strict, hard and fast rules. There's no subjectivity. There's no gray areas. It's black and white rules for what determine your trading edge, which I'll talk about later, the components of your trading edge, which are going to include things like your entry criteria, your exit criteria, your risk management, and these sort of components. So that's the first thing, is you need to objectively define your edge. The second thing is that you need to predefine your risks. So for every trade that we're going to put on, you have to understand that there is a predefined risk, and that may be a certain amount of ticks, or that may be a certain percentage of your account or a certain dollar amount of your account, but you need to predefine the risk prior to ever getting into the trade. The third thing is you must not only predefine the risk, but you also must accept the risk. But you must also accept the risk, meaning that the risk is small enough that you're willing to accept the risk and you're willing to let the trade play out in its entirety until it either hits your take profit or it hits your stop loss. The fourth thing is that we're going to act on our edge without hesitation or reservation. So we should have already objectively defined our criteria that defines our edge, and we're also going to act on it without reservation and without hesitation. So the way you should think about this is, how would a robot trade this strategy? They probably wouldn't have second guesses. If it meets the criteria, boom, they're in. If it meets the criteria, boom, they're out. And so we need to act on this edge without hesitation or reservation. Number 5 is to pay yourself as the market makes money available to you. It doesn't really make sense to just try and pay yourself weekly or try and pay yourself monthly. Yes, it's okay to have goals like this, but at the same time, we can only pay ourselves as the market makes money available to us and as our edge is played out over a long period of time. And as we know, there may be some weeks or some months where we don't make any money at all. So it may be tough to pay ourselves during that month, obviously. Number 6 is to monitor your susceptibility to errors. Okay, so you're likely going to make errors throughout this process, and you kind of have to take a step back and look at, what am I actually doing? And that's why so many people will recommend having some sort of trading journal, which is basically, why did you enter the trade? Why did you exit the trade? What was the result of it? Any emotions that you're feeling? And number 7 is to never violate these rules. If you stick with 1 through 6 and you don't violate these rules, you should start to have a lot more consistency in your trading. So those are the 7 keys to consistency. Now let's go ahead and talk about the 5 fundamental truths. The first fundamental truth is that anything can happen in the market at any time. And this is kind of interesting to think about, because the reality is the market could fall out the bottom, or if it could go skyrocketing at any moment at any time. And as traders, we have to be okay with that. And that leads us to the second fundamental truth, is that you don't have to know what's going to happen next in order to make money in the market. And when I first got started, and I think when most traders get started, they think that they have to be able to predict what's going to happen next in order to actually make money. And the reality is you don't need to know what's going to happen next if you simply have an edge, which is basically a probability that something is going to happen higher than, and then you have to let it play out over the law of large numbers. So you don't in fact need to know what actually is going to happen next in order to make money. We just trade our edge like a robot. And that leads us to number 3, which is there's a random distribution between wins and losses for any edge, meaning that you may go through a series of losers and you may go through a series of winners, but these wins and losses are completely random and we don't know when they're going to come. You may start trading a new strategy. You may go on this losing streak where you lose, 4 or 5 trades in a row and you may think, hey, this strategy doesn't work. And you go through this pitfall of system hopping where you go to this new trading system and right as soon as you left that old trading system, the very next trade was a winner. And this is a pitfall of a lot of traders, but there is this random distribution between wins and losses. The fourth thing is an edge is an indication of a higher probability of one outcome over another. So when we're talking about edges, it's important to know that all we're talking about is a higher probability. That's what an edge is. We know that, in the casino, the house has a slight edge over people that are gambling in the casino. And even though they have that slight edge, they let it play out over a long period of time. And that's how they win their edge. Now, the fifth fundamental truth is that every moment in the market is unique. Okay. Each moment is an independent, unique outcome. Now, the next section talks about thinking in probabilities. And the first thing that we need to be aware of is that anything can happen at any time. And we've been talking about this a couple times, but that's the reality is anything can happen at any time. And we don't need to know what happens next in order to make money. The second thing in far as how to think in probabilities goes is we need to understand that outcomes to individual edges are independent of each other in a small sample size. However, over a series of a large amount of trades, it should produce consistent results. So while, if you're just trading a system for say 5 or 10 trades, you may think, wow, this is quite random, or wow, this is not a good trading system. But as you let more and more trades happen, then this is where you're able to create consistency. The more trades that happen, the greater the probability of the edge playing out like it should and being able to create consistent results. The third thing is to predefine our risk, which we talked about, to cut our losses and to systematically take profits. We'll talk about this a little bit moving forward. Number 4 is to understand that every trade has an uncertain outcome. Again, we don't need to know what happens next. As a matter of fact, our belief is that this outcome of this trade is completely random. That's why when people ask me, hey, do you think the market's going to go up or going to go down? I say, I don't know. Okay. And I don't have to know in order to make money because I'm just playing my edge over a large series of examples. Number 5, the best traders treat trading like a numbers game similar to casinos, right? I likened this earlier. Casinos, they basically just have generally like a 5% edge over gamblers. And there may be hours or certain days where casinos may lose hundreds of thousands, if not millions of dollars in the period of a short, but the casino doesn't just stop and say, hold on. We got to rethink our algorithm. We're closing the doors. No more gamblers are allowed to come into the casino right now. No, they don't do that because they understand the law of large numbers will play out in their favor. And that's exactly how the best traders think about trading. They don't get all emotional or change their system as soon as they experience some losing system. After they experience some losses, they just continue to trade and let the law of large numbers play out. Number 6 says that each trade is unique and independent from any other trade. So you may see a series of losses or you may see a series of wins. The temptation is to use recency bias, which is a fallacy that humans have and our brains have, that we think that whatever happened recently is likely to happen again, right? So if we had 3 trades that went on winners, then we may think, hey, this next trade is probably going to be a winner as well. I've been doing so well, so I'm actually going to increase my size here on this next trade. And this is a big, big problem because each trade has a completely unique and independent outcome. Just like when rolling a dice, you always have a 1 out of 6 probability of rolling any certain number. The same thing with a trade. Each outcome is independent of the previous. So we always have a 1/6 chance no matter what happened the past 50 rolls. Even if the past 50 rolls, we all rolled a number 3, it doesn't mean that the 51st try that we roll is going to be a 3. We have no higher likelihood of it being a 3 versus any other number. And number 7 is to be rigid with our rules, but flexible with our expectations. So again, we want to be trading like robots, and also we need to be flexible with our expectations because over any large period of time, we're going to go through swings with our trading systems, right? We're going to go through ups and we're going to go through downs with our trading system, according to Mark Douglas. Now let's move on and talk about 3 common problems amongst traders. Number 1 problem is that they're unwilling to create rules, okay? Now, you can't tell you how many people that we've seen come into our communities that struggle just because they will not create hard and fast rules for themselves. And actually, for myself, it wasn't until I actually started trading algorithmically or robotically that I actually started seeing success because it kind of forced me to actually create rules, because the trading system was based on some sort of rules or entry criteria and exit criteria. The second common problem is the failure to take responsibility. Most traders will blame things like, oh, the broker manipulated me, or the market did this, or it's just not good conditions, and they're not willing to take responsibility for their system and for their actions. And the third common problem is the addiction to random reward. For example, we may be trading a system and we may notice that, hey, I just noticed that, when, the RSI crosses over this certain number, that the past 3 trades that we did that, we actually ended up making a whole bunch of money. Well, you get addicted to these like random rewards, and that may cause you to want to change things in your system. However, if you've not tested that previously over a long historical period of trades, then this is really just gambling and you're becoming addicted to random rewards, right? The scratchers, that's why people play the lottery, is because they do get random rewards and they don't know when it's going to come. So humans, as just humans, we do have this addiction to random rewards. It's how we're built. The next section talks about the 3 stages of development of a trader. The first stage is to become a mechanical trader. And this is where you just trade your edge definitively like a robot without thinking about anything. You just do black and white trading. And this is, how an algorithm would trade or how a robot would trade. The second stage after that is to become a subjective trader. This is where you're still trading mechanically, but you also use some of the things that you've learned throughout your years of trading, and you're able to get a little bit better feel for the market where you're not just strictly trading mechanically. And then the third stage is where you actually become intuitive. And this is the highest level of traders that have been doing it for a very, very long time. They're able to kind of feel the markets, okay? The next section is how to actually trade your edge, or what are the components that actually make up a trading edge. The first thing you need to do is you need to pick your market. So what is it that you're going to be trading? Are you going to be trading forex? You're going to be trading stocks, cryptos? And if so, which assets are you going to be trading? The second thing that you need to do is choose variables that define your edge, which is going to be, the things that we talk about next, like number 3, which is our entry criteria. So you need to have certain variables that cause you to actually enter a trade. And that could be using some sort of support and resistance. It could be something with trends or trend lines. It could be something with indicators like moving averages that cross. Any of these things could lead to the entry of your trade in your edge. Number 4 is to define what your stop loss is going to be. And generally in this book, he says that it's best to use market structure versus just some percentage or some dollar amount that you lose on your account before getting out of the trade. He says it's best to use some sort of market structure, which could be a resistance or support zone. Number 5 is to decide on your actual time frame that you want to be trading on. And it doesn't matter if you're going to be a scalper, a swing trader, whatever fits your personality and your time schedule the best. But the idea here with your time frame is to make sure that this is both the entry and the exit criteria are both based on this same time frame. Number 6 is to take profits systematically, okay? And you need to have some sort of criteria, whether it's a certain risk to reward or if it's at a certain market structure or something specific happens that you need to be able to know when to take profits. And you can also scale out of your positions. But in the book, Trading in the Zone, Mark Douglas does recommend trading with like at least a 1-to-3 risk to reward ratio. Now, obviously you may be doing something different depending on your style. This is just what he recommended. Number 7 is that you need to define all of these things that I just talked about, 1 through 6, and then you need to test. And the larger you can test over, the better. But he says that you need to sample at least 20 trades in order to get an idea of how the system would perform. And if you want to do even more, that's probably a better idea. But you want to both back test your trading strategy, and then you want to forward test it on a demo account, and then a small account, and then move on to your large account to make sure you understand how do you actually trade the system, and you get the practice for how to see it without having to risk any of your own money. Okay, and the last section is what are the criteria to actually go ahead and put on a trade. And the first thing is that we need to know that the edge or the odds are in our favor prior to putting on the trade. Well, how do we know that? We've defined our edge objectively, and we've also gone ahead and actually tested this theory. The second thing is we need to decide on what the cost to find out if this trade is going to work is. So we need to, again, predefine this risk and accept this risk, and to be able to bet this entire amount in our trade to see if it'll actually work out or not. And then the last thing, number 3, is we don't need to know what's going to happen next, okay? This is just a reminder, and it's kind of one of the big themes of this book, is that you don't need to know what's going to happen next in order to make money. So the next thing that you need to do is click the link below on the description to download this mind map so you can keep it on your desk and you can reference it. And also, if you're looking for an edge that actually does have an edge, then go ahead and check out this video right here. It's a 5-minute scalping strategy that we use in the mornings for just a short period of time. Has been working extremely well for our members. Go ahead and check that out right now.